It's something I talked about last week. I think position and sentiment is most of it. I mean, last week people were so depressed about the market and just selling with really no fundamental reason. Just sentiment was so poor, and I think that was half the snapback that we've seen over the last week, if not 2 weeks. Another thing is I think people right now are hopeful that the many catalysts that are on the calendar in front of us has something, maybe a bright hope for people, whether it be the G20 meeting that's coming up this week, or the ECB meeting on March 10th, or even the Bank of Japan meeting later in March, or the Fed meeting. All those things are catalysts that might just keep us confined. A lot of intraday volatility, but no fundamentals really changing.
Larry, do you think we could be in this situation for a little while now, simply because, as you said, we own risk assets, we own equities, owning bonds hasn't paid off a lot, and rates are very low. And every time you get a correction, 5 or 10%, people are not going to feel very well. And then you have elections coming up in the U.S., any of the candidates, you don't have a real clear picture of what they're going to do with the economy. Right. All of that's, I find it hard to imagine what to be positive about in the U.S.
Yeah, no, that's a great point. I mean, right now it reminds me a lot of like part of 2014 where we sat in a range for a very long time. And there could be a lot of puts and takes, which there have been every day, moving the market 1% one way, 1% the other day. But at the end of the day, the fundamental narrative isn't changing, and the market's not changing on fundamentals, changing on sentiment. I happen to be more bullish than most people, but not an uber bull by any stretch of the imagination. But I'm fully aware of how sentiment itself can turn into a fundamental, and that's a scary thought.
If we look at earnings multiples at the moment on markets, I mean, are markets still looking pretty overvalued at these levels? I mean, are any of those gains at the moment, further gains in the market, likely to be capped because of those high multiples?
Yeah, that's a good point. I don't think that, $120, that's the number we should really be concerned with, the 16 times multiple. That would get the S&P to about 1950. In my mind, that's not expensive. That's not ultra expensive, and it's very doable. What I guess is scary to most people is that $120 for the S&P 500, is that accurate, or are we going to continue to see more recessionary environment in revenues? And if global growth is tepid, if it stays the way it is now, then the answer is yes. I mean, we're vulnerable. But on the other hand, we have seen stability, especially in commodity prices. The dollar isn't zipping like it was last year, so perhaps the $120 number is right, and 16 times multiple, that's fair in my mind, and 1950 is the low end of where I think we'll be by the end of the year.
Larry, do you think risk now for the U.S. is not what happens internally, but what happens externally? For example, China depreciating their currency, or Chinese equity markets going down, or, Britain trying to leave the EU. These are things that are not in control of the U.S., but does affect the U.S. economy, hence consumer confidence and growth.
Yeah, no, yeah, definitely on a short-term basis, all those things you mentioned will hurt our market and have hurt our market. But the fact is, we're seeing signs that China is basically opposed to letting their currency go into free fall. Not that they can stop it forever, but they've been pretty aggressive at putting policy in place. When it comes to the central banks in Europe and in Britain with Brexit and all that, absolutely. But the bottom line is, I think here in the U.S., people talk about recession. I just don't think that's where we need to be talking about right now. And just disinflation, deflation, all that, especially when you have how well we're doing here with jobs growth. Housing is about 5% away from the 2007 peak, and rates are still low. So I think it's pretty good here in the U.S.
Of course, Larry, we know oil prices very much weighing on markets at the moment. The strength, though, that we were seeing in commodities, especially oil there, that seemed to be unravelling a lot of those concerns about disinflation, as you touch on there. Of course, that all seems to be changed again today with talk around the Saudi Arabia oil minister. But nonetheless, I mean, in the short term, do you expect to see more volatility in those crude markets?
Yes, absolutely so. I think we'll see a lot of volatility in the markets, enough to scare people and make them do things that they probably shouldn't do. I still am firmly a believer that will be balanced by the end of this year, and might even see a draw by the end of 2016. That's an outlier position, but I firmly believe it. I think all the news headlines that we've talked about, either this week, last week, or 3 weeks before, they're all the same thing. There's nothing real. But behind the scenes, we're seeing non-OPEC production is de-accelerating. OPEC is not accelerating. It's staying stable. As long as the demand in the world remains constant, we will go into a balanced situation, and I think it's way overdone.